Hello and welcome to Economy and Markets TV. This is the show that takes you around the world of economic and financial news. I'm your host, Dave Okenquist, Senior Research Analyst here at Dent. Today I bring on the Senior Editor and Co-Founder of Dent Research, Mr. Rodney Johnson. Rodney, good morning.
Good morning, Dave.
Good to have you on for our weekly recap show. Rodney and I go through the most important news items of the week, and we have one rule. We try to keep things moving and every topic under 2 minutes. If we go over 2 minutes, I will ring that bell to get us moving along. Right, Rodney?
Yep.
All right, let's just get right into it. Our first topic is the trade wars of 2018. Not only do we have some existing tariffs that went on and the China response, now President Trump has asked the trade representative to find an additional $200 billion of goods to tax at about 10%. This thing is not ending, apparently. The markets seem to oscillate on the news, which seems to change every day or every other day. What do you make of this latest move, Rodney?
Well, it's important. I mean, we've talked about this obviously for months since it all started, really back in January, if you go back to the first mention.
Right.
It's not a tax, it's a tariff. But the idea is that we bring in more goods from them than they do from us, so they can't match. So when we go from the first $34 billion to $234 billion, presumably, they can't match that because they only import about $150 billion worth of our stuff. The difference is it doesn't have to be a true import tax or tariff. It can instead be a slow walk. And that's what the Chinese look like they're preparing to do, where they hold up many more shipments for inspection at the borders, or they kind of slow walk paperwork or approval. And so they effectively hold things back from the market, which of course can be just as disruptive. So the big question is, why are we still kind of looking at this and going, maybe it'll be okay, right? Should be great. Whereas our equity markets are walking higher. The Dow is back positive for the year, and the Chinese market is still down 20% or more for the year and looks like tough times. Those reflect some basic things. Our economy is doing better than theirs in terms of a trend, in that we had a boost from tax reform, and we've been kind of walking at this 2 to 3% GDP anyway, where theirs was growing quite quickly in the last decade and has actually been slowing for a long time, and they're increasing their central bank intervention to make it happen. So the trade war comes at a bad time for them and a good time for us. If you're going to have one, do it from a position of strength, which is what we're doing.
Yeah, absolutely. Just before we wrap up this topic, is there chances we're going to push a little too far? Will we get a sense when that's going to happen?
Oh, of course, right? I mean, my goodness, how could a president like Trump not push it too far?
Yeah.
But what does that mean? I don't know. Nobody knows. It's one of those things where you look backwards and go, wow, maybe we shouldn't have done that. Maybe it worked like it's supposed to. So, yes, it can. And that's the big worry because no one knows where that line is.
Yeah, absolutely. All right, great stuff there. Let's hit our next topic. Didn't mean to scare anybody about pushing too far, but we're hopefully everybody's got a good sense of what's going on here. But all right, next one here, we got mortgage refis fall to the lowest level since 2000. So we know that mortgage rates have fallen a little bit, but as you pointed out in the text today, we're still well above the 4% average for the year. What are the implications of this declining rates of refinancing?
It's the banking sector, right? And more importantly, or more specifically, the mortgage lending area. And there are a lot of companies that focus just on mortgage lending. And so they had a really good business over the last several years. We're not back where we were in terms of the high of the markets in the early 2000s or mid 2000s in home buying or purchases. But if you're looking at the growth from about 2010 or 11 in terms of purchases and refinancing, they've been in a growing area because as long as interest rates were low and kind of marching lower, refinancing made sense. Well, at 4.75% for the average 30-year mortgage versus 4% at the beginning of this year, who needs to refi into that? If you were going to do it, you did it years ago. And so that business coming off is not going to be replaced by a lot of additional purchases. That business is growing very slowly. And so what it means is mortgage lending businesses are going to have a hard time finding a replacement for that business that was refi. And so those types of businesses should suffer.
Okay, so what does that mean to a typical investor? Or should we expect to see some kind of decline in bank stocks, or what's that going to mean for us?
It's a good question. And it is the bank stocks, it's the regional bank stocks, perhaps a little bit more, or even those companies, like I said, that focus just on mortgage lending. And so there are a number of those. And so you need to find out what your bank investments base their business on. And if it is a significant portion to refi, that's something that should concern you in the months ahead.
Last thing on that, Rodney, if banks don't have that refi money coming in, is there a possibility? I've heard some horror stories about conventional mortgage applications. Is there a possibility that they might be a little bit more lenient on that?
Well, I don't think so, because original mortgages in terms of primary home buying, that's really driven by the federal government and their qualifications for Fannie Mae and Freddie Mac. People aren't doing subprime like they did before. Now, Fannie Mae and Freddie Mac are doing 3% down loans, which is kind of crazy in and of itself. But because those are federal guidelines, if you make a loan to that guideline, then you can roll them right into the federal insurance program, and you don't have to worry about it as a bank.
Excellent. Thank you, Rodney. All right, our next topic is really two topics in one. It deals with inflation. We've got on one hand producer price index. That rose 0.3% in June and a whopping, which I think is really high, 3.4% for the year. We've got energy prices rising. Rodney, this is a topic that you're going to talk about in the upcoming boom and bust. Talk about that a little bit before we get into consumer prices.
Yeah, producer prices are prices among wholesalers, right? You know, when a company buys supplies from another company to make the product, it's the price change there between those two wholesalers. Right. And so to see those prices go up, there are only two choices there for what happens next. Either the person who was purchasing that had to pay the higher price eats the difference, and so it lowers their profit, or they pass along the increased price to their customers, and it leads to higher prices for us as consumers. And so that's the big question on the table is, does that eventually lead to inflation? I think it will, particularly in a couple of areas like transportation, where we've seen the prices hold lower than arguably they should have, right. And it's going to lead to a wage question down the road.
Yeah, absolutely. Looking forward to hearing you get more into that. On the consumer price end, they were up nearly 3% for the year, up 2.3% if you exclude food and energy, what they call core inflation. It's been over 2% yearly growth since September 2017. So inflation definitely is here, Rodney.
It is, and it should be, right? If we look at what's gone on with inflation, really since the downturn, we haven't had much. And so you want this to come back so that you have people motivated to keep money in motion instead of holding it back, the savings paradox, the savings trap, whatever you want to call it, right, where people hoard cash and don't spend it. This is what the Fed has been trying to do for a long time. I'm not going to go to the Fed succeeded, because I do not believe they did. What I believe they did was waited around long enough to where inflation came back to them. So they can call it a win, but it really didn't have much to do with them, or else it would have happened a long time ago. Yeah. And so what it does do is it allows the Fed to stay on track, raising rates 4 times this year. And that's going to be a weird thing, because they keep raising short-term rates, even though long-term rates aren't going higher, which could lead to a flatter yield curve, which has problems of its own, particularly for banks, because they make money by lending long, by borrowing short. And if those two rates go together, banks don't have as much profit.
Yeah, absolutely. I'm going to let this topic run just a little bit longer, because you had something to say about core inflation in today's written piece, so I want everybody to hear that.
Well, core inflation is kind of the point of taking out food and energy. And as Barry Ritholtz said many years ago, it's like measuring inflation without inflation, because food and energy are the exact things that you need every day. They're the basics or necessities in addition to shelter. And so if you're measuring the increase in, say, car purchases, we don't have to do that every day, but we do have to eat, and we got to get places. And so it seems kind of disingenuous to measure inflation without core, but that's what the government does to try and smooth things out.
Yeah, and to that point, food last month was up 1.4%, not massive, but energy was up 12%, I think, for the year. So that makes a big deal. I mean, to just exclude that, that's real money you have to pay, at the pump, or really every input into the economy, right? So point well made there. We have a last tiny topic here. This one's on Tesla. News came out that they hit their production goals, and some of the consumer rebates that come from the government are fading out. Rodney, can you explain this one a little bit?
Right. And so there are two things going on here. We don't want to mix them up. Tesla makes, obviously, electric vehicles. Right. And so they're all electric vehicles, zero emission. That's the key, zero emission. And so because they do, they fit some parameters that the government wants. The government says all car manufacturers have to make a certain number of zero emission vehicles, which they don't. They don't sell enough. And so the other car manufacturers buy credits from Tesla because they have so many. That business remains the same. Tesla's going to keep making money from selling those credits. But we as consumers get a break on buying electric vehicles from companies that have not made, or rather sold, 200,000 units. Tesla just hit that mark. And so their $7,500 tax credit per vehicle is going away. It'll be cut in half in the first half of 2019, and it'll be cut down to a quarter in the second half of 2019, going to zero by 2020. Now, if you're buying a $100,000 Tesla, maybe you don't care about the $7,500, although you might. You probably don't care as much about, $3,250 or $3,750, sorry, and then, the $1,900. But if you're buying a Model 3, which is, of course, supposed to be their, everyday American car for $38,000 or $40,000,
right,
losing that tax credit is important. It's very important. And so this is a big question as to what it's going to mean to Tesla trying to get their price point down to what the normal American family can buy.
Yeah, and as you say, you like the company, but the stock price just doesn't make any sense, right? It would seem like if this thing is going to stay the way it is, it's going to be hard to see how they're going to move that many units. So does that mean the government's going to come in and issue an exemption or something like that?
I bet they do. I think they'll change the law, right? I don't necessarily like the company of Tesla. I love the cars, right? I want a Tesla Roadster. It is what it is.
Right.
I would buy the old one that they discontinued, 7-8 years ago. I would certainly buy the new one if it came out because they're so darn cool and fast. But it doesn't mean they should succeed as a company the way they're doing things, because I just think they're going to get overrun by competition in the next couple of years as other manufacturers blow right past them in their ability to get cars out the door and service them and all sorts of other things. And so it's going to be very interesting what happens. On this particular point, I bet Tesla does apply for and get some sort of extension of that law to say, hey, guess what? We're the only ones producing electric vehicles at any rate. You should clearly come and help us by this.
Yeah, absolutely. Great stuff, Rodney. As always, that's all we have for this week. Looking ahead to next week, we've got retail sales and housing starts. Anything else on your mind, Rodney?
No, it's going to be kind of a slow week, like this week was. It's the middle of the summer. Earnings are the big thing. We're starting to get them right now. And we'll get more corporate earnings next week. I expect earnings to be up around 21-22% over last year at the same time, as most other people do. It's all about corporate tax reform. The question is, what are companies doing with it? And the answer is not much. Buying back stock, paying a bit more in dividend, but they're not investing at this incredible clip that everybody had asked for.
Okay, Rodney, thank you very much for joining me. Thank you all for watching, and we'll see you next week.